Bank of America is a US banking giant. Market cap here $235.4 billion US dollars. Trading on a PE of 14.4, dividend yield here of 1.3%.
So we put this one up because really it's like the US bank that you would wish that you had owned for the last 5 years, because look how well it's done.
Or you could have just bought it there 2016.
When Trump got elected. Yes.
And you would have done very well.
Mm-hmm. So now what? The question really is, can one buy them at present levels? Remember also they own Merrill Lynch, which was an asset they acquired in the middle of the financial crisis, which is present inter alia in countries like South Africa.
Nesan, your thoughts on this one?
Listen, I think from the US bank's perspective, there's a lot of things that they've got going for them right now. You know, we're in an upward interest rate environment in the US, which is very good for bank margins because they can price their loans at higher and higher rates. They call it an endowment effect in the industry. You know, on the regulation side, Paul mentioned, you know, the Trump effect, the fact that Trump was going to ease up a lot of regulations in banks. We'll still have to see. He's got another 3.5 years or so in order to achieve that. But, you know, the outlook is very positive if he can achieve that. And then we've just been through all these stress tests now in the US, which showed that the health of US banks is still, you know, very good, enabling them to increase their dividends and to return value back to shareholders. You know, those things.
Bank of America hasn't taken advantage of that because we're sitting at a dividend yield of 1.4% at this point.
But remember, that's historical, and that's been, you know, one of the factors that contributed to that was the fact that they couldn't actually increase dividend yields without going through these stress tests.
But now they can, so we could see that dividend yield changing.
Yeah, now they can. Citibank is probably the ones going to benefit most from these stress tests because you know they came off quite a low base. And of course, you know, lastly, the US economy is quite vibrant, it's quite robust. Lots of M&A activity taking place, especially the big tech companies. And so I don't think you can ignore an investment in US banks at the moment.
Paul, your thoughts on the big boy out of the US?
Well, I mean, it's interesting that you say the big boy because the big four are really Bank of America, which is what we're talking about here, JPMorgan, which sort of did better in the crisis, but is more an asset-based operator, but is now kind of looking the most expensive. Then there's Wells Fargo, which did the best in the crisis, but has since done badly because of internal wranglings and those incentive issues. And then there's Citibank, which really got utterly decimated in the financial crisis and hasn't really recovered much yet. Interestingly enough, Bank of America currently trading at the share chart price that you saw.
Well, let's put it back up. There we go.
Its all-time high was in fact $54. So it really got hammered and it has come back very nicely.
But there's still a lot of potential upside,
well, I don't know, because I mean the all-time high, that was a different time, really. I mean a really, really different time to where we are now. So what's its price to earnings ratio there? We did mention it earlier. It's listed there, 14.35. I think there's another issue I just want to quickly put on the table is that all of these banks, particularly in the US, have got enormous opportunity to cut costs because traditional banking in America is still very traditional. They write checks. They post checks to each other when they want to pay each other.
Hot or not on Bank of America, unless you've got something else to add as well, Nesan?
Listen, I'm not unhot on it. I'm getting hot on it. The only thing concerns me about Bank of America is amongst the US banks, it's got a very low return on equity at 8%. But I imagine with, depending on the pace of interest rate increases, if we do see a normalization in rates, I think they can get that to 10%.
Yeah, and I'm going to go hot on the cost-saving potential. I think they're too cheap relative to their earnings power, and I think most of the bad news and the fines and all of that stuff are now permanently out.
So we've got a hot and a
hot.
And a hot.